Welcome back to Riding Academia. We are still on our series on the final account of a sole trader, and then today we are going to be looking at the statement of financial position, which is also called the balance sheet. All right. Now, the balance sheet is a summary of the assets, the liability, as well as the equity or the capital of the business, all right, at a particular year, at the end of the year, right, at the end of the trading period for a business year. The summary of the asset, the summary of the liabilities, and the capital, right, or it's also known as the equity, right, of the business, is shown in the statement of financial position. Okay, now in our trial balance, we are going to be giving information or information on there are various information in the trial balance, right? So we will need to know when and which belong to which account, right? Because from that trial balance we are picking certain information for preparing the comprehensive income statement. From that same trial balance we're also picking certain information to prepare our statement of financial position, right? So now on the board, what we see here is the format for the statement of financial position of the business. Okay, now we are starting from the non-current asset. We are still using the vertical method, right? We are starting from the non-current asset of the business. Okay, now the non-current asset, they are also sometimes called a fixed asset, right? They refer to assets that can last longer than a year. That's why they are called non-current. Current asset only lasts for 1 year, like they can only last highest is a year, right? So the non-current asset can last in the business for more than 1 year, all right? So we're looking at the non-current asset like the premises, okay? The business premises, the land and building of the business, they can last for more than a year. And then we are seeing the motor vehicle, all right? And if there's a delivery van, we are looking at the furniture and fitting of the business, the machineries of the business. Now, if you look very well, on my naira sign, okay, on the currency sign, when I'm preparing the non-current asset, I indicated the cost, right, the accumulated depreciation, and the net book value. So we try in the balance sheet, which is the statement of financial position, right, we try to consider the cost of our assets, all right, as well as deduct the depreciation that was accumulated. If you have watched our videos on depreciation, okay, you will understand what we are saying here. We try to less the accumulated depreciation, all right, for those assets, and then when we less that from the cost, what we get is the net book value, all right, of the non-current assets. So when we total up the net book value, we arrive at a given figure, right, and then we go to the current asset. Like I said, non-current can last more than a year. The current asset can only last a year, all right? It cannot last more than a year. It can only last a year, all right? Now we have our cash in hand. That is the physical cash we are holding. Okay, that's liquidity. The most liquid assets of a business is what we call the cash in hand, the physical cash you are holding. Then we have the cash in your bank account, right? And then we have the stock. This stock here is the closing stock, okay? It refers to the closing stock of the business. That is the goods available at the end of the trading period, okay? And then we look at the debtors. Our total debtors is also called the trade receivables, all right? If you don't see debtors, you see trade receivables. Now when we get our debtors, you can see that every other current asset was coming on the second naira sign, and then I brought in debtor on the first naira sign because we have to adjust for debtor. Now when we go further in adjustments, maybe we'll be understanding this better, all right? But the only adjustment I made here was the case of provision for bad debts, all right? We can make adjustment for provision for bad debt. We'll be lessening those provisions from the actual debtor amount, all right, to get our net debtor. This is the expected amount for the business, all right? So we are going to less that provision. A part of the debtor's fee, all right, has been kept aside in case some are not able to pay, all right? So it's like an allowance. We're going to be lessening that amount, and then we'll be getting this, right? And then our prepayment. Now the prepayment refer to the expenses that they are not yet due, but we already paid for them, all right? That means we're not yet it's not yet time to pay, but we have paid ahead, all right? So when you pay ahead, the amount that was paid ahead of the year is what you call the prepayment, okay? Prepaid expenses or prepayments, right? And then we have the accrued income. Now the accrued income means this income is due to the business, but it has not yet been received, all right? Prepaid expenses are expenses that is not yet due, but we have paid ahead, all right? Now the accrued income is due by the customers or whoever the people we delivered services to are. All right, so these expenses are the accrued income. These income are due to the business, right? But as at yet, okay, as at when this account is being prepared, those income has not yet been received by the business. All right, so that's what we call the accrued income. Okay, now we go over to the current. Now when we add this, okay, we get the total current asset value. Right, now we go over to the current liabilities. Now the current liabilities refer to obligation, financial obligation that is due to the business within a given year. Okay, within a given year. Now we have the creditors, those who the business is owing, also called trade payables. We have the overdraft. Now the overdraft refers to the loan given by the bank to current account holders, and that loan is payable in a year time. At the highest is a year. Okay, there's a difference between the overdraft and the bank loan. They are two different things. Okay, whereas the bank loan is a long-term liability, although it wasn't included here anyway, it's a long-term liability. The bank overdraft is a short-term liability. Okay, and then we have the accruals. The accruals here is also called accrued expenses. That is the expenses that are due to the business, but the business is yet to pay them off. Okay, businesses is here to pay them off as at when this account is being prepared, so they are owing. Okay, it's also a liability. Everything liability has to do with an obligation on the business. That is, the business is owing somebody, is owing outsiders. All right, that's what we call liabilities. Okay, now we have the prepaid income. In this case, is the opposite of the accrued income, right? In this case, outsiders has paid the business for particular services that they have not rendered. All right, they have paid the business for a particular service that the business is yet to render, so the business is also owing those people who has paid. Okay, so everything you see here, it means the business is owing somebody an obligation. All right, then now when we less the total current liability from the total current asset, all right, we are lessing the total. You can see on the second arrow sign, the total current liability from the total current asset. What we'll be having is our working capital. All right, when we have our working capital and then we add that to the total value of our non-current assets on the third arrow sign, right, you can see we add it to the total value of our non-current assets, then we'll be having our total assets. Okay, now we can either choose to stop here, or we can also less our long-term loan, that's our long-term liabilities. Okay, at this point we can less if there is any bank loan given. Okay, we can less long-term liabilities from the total assets. Okay, good, then we'll be getting our figure, our value, right? Then the next thing we'll do is to look at the financial part of the business. This is where we consider the capital of the business. All right, the finance by these are how the business is being financed. Okay, now we have capital, the money used in starting up the business, or we can also say the value of the resources used in starting up a business. Okay, is what we refer to as the capital. So we see the amount or the value of capital, we'll be adding our net profit. Okay, so we add our net profit, the net profit gotten when we had prepared our statement of comprehensive income. All right, we'll be adding the net profit value to the capital value. That means the net profit will be bringing an increase in capital, right? And then we'll be deducting drawings. All right, the drawings now can be referring to goods that were withdrawn or cash that was withdrawn. Okay, the total drawings will be less from the value we've gotten. Okay, we'll be lessing our drawings, then we'll be getting the total, the net amount available in the business. The idea of the balance sheet is that at the end of the trading year, right, because there's a formula followed that asset is equal to capital plus liability. So at the end of preparing this account, it should be that our account, all right, it should be balanced. That is called a balance sheet. That is, there should be a balance, all right, between the assets and the liabilities and the capital. All right, but using the vertical method, so there should be a balance between our total assets and the total amount of finance in the business. All right, that's the idea of the balance sheet. So we'll be taking an example after a short break, and then we'll be solving together in regards to this. Stay with us. All right, welcome back. as you can see before us is a picture of a trial balance, right? We've used the same trial balance to prepare the trading account where we got our gross profit. We've used this same account to prepare the profit and loss account where we were able to obtain our net profit. And so we'll be using this same account to prepare the statement of financial position. So what we do is that we have to identify the items, all right, the items in this trial balance that we'll be using to prepare our statement of financial position, okay? Like as you can see, we have our motor vehicles, our furniture and fitting, our cash in hand, cash at bank, the drawing, loan, the capital, all right? These are the items, and as well as our closing stock, all right, that we'll be using to prepare our statement of financial position. So stay with us. All right, so this is our statement of financial position, right? The first thing we are doing here is the title of this account, all right? Job and Sons, right? The title of the owner of the account, the name of the owner of this account. Then the next thing we have is the title of the account. That's the statement of the financial position as at 31st December 2015. This is how it is addressed, all right? Statement of financial position as at, all right? Now you can see our naira signs, and like I said, when we are treating our non-current asset, we take note of the cost of the asset, the accumulated depreciation, and the net book value. So we attach that to the naira sign for clarity, all right? Now we can see we just have from our illustration or from our trial balance, we just have two non-current assets, which is our motor vehicles and the furniture and fitting. Although from the trial balance, we're not giving any information on the accumulated depreciation. That's why this place is blank, all right? So the net book value remains the same. Okay, now we move to our current assets where we have the cash in hand, we have the cash at bank, the closing stock. The stock here refers to our closing stock because the stock available in the business at the end of the period, all right, is part of what we consider. We have our receivables, which is our debtors, right? And then when we add together, we'll be having this amount for our total current asset, right? Now we now take note of our current liabilities. Our current liabilities, in this case, we just have only the payables. That's our creditors, okay, the people we are owing, just the payables, all right? So when we less that from our total current asset, what we have as our balance, as you can see, is our working capital, all right? When we add our working capital to our total non-current assets, right, total non-current assets, we add to our working capital, we are supposed to be having our total assets. That is if there is no long-term liabilities, okay? But in this question, we have a long-term liability, which is our loan, okay? Like I said, loan is different from bank overdraft because loan is a long-term liability, right? It's payable even more than a year time, whereas a bank overdraft is a current liability because it's payable within a year. The most it can hold is a year. So when we less our loan, and then what the amount we'll be having is our total asset. That is, we less our long-term liability from the figure we had, then we'll be having our total assets, all right? This is our net assets for the year, okay? Now the accounting equation holds that capital plus liability is equals to assets. Now using the vertical method, we can now interpret that equation as assets minus liability to be equal to capital, okay? So we have subtracted both the current liability as well as the long-term liability, right? So it means our answer should be equal to the capital. Okay, now we go to the finance. This is where our capital comes in. So our capital, the amount used in starting this business, is this. So we're going to make adjustment on capital for the year, right? Capital grows, capital can depreciate. So if it grows, that means net profit is high. Okay, now this is our net profit. When we add, we have this amount, and then we take note of drawings. Okay, drawings will reduce capital. So what we are doing here, we are adjusting for capital, right? So this is our capital that was brought forward. We add our net profit, we get this, and we also reduce our drawing to get this amount. Now, like I said, when we have asset minus liabilities, our answer must be equal to the capital. Are we there now? So this is why our statement of financial position must always balance if we apply the correct principles. Okay, as you can see, so this is a balanced account. The capital amount is equal to that of the asset minus the total liabilities. Okay, so with this, we've come to the end of our videos on the statement of financial position. Don't forget to subscribe to this channel if you haven't. Like our videos, share our video with as many as possible. We'll see you in our next class. Thank you.